Okay, good afternoon and welcome to today's session. End of financial year is fast approaching. Another one has almost bitten the dust. Jason Roccasolvo here, partner of TAG's Superannuation Advisory and Audit Division. With me today is the manager in our division, Emma Partenza. G'day, Emma.
Hey, hello.
Thanks all for joining. You'll see, or you should have access to, on the right-hand side of your screens, a chat section. We've got the slides available in there for you today. As per all of our sessions, we love them to be interactive. So feel free to type anything in the chat area there, and time permitting, we'll try and make sure we get through as many of those questions as we can. If we don't get through them, we'll get through them and we'll get back to you separately after the session. Equally, if you're too shy, email us at super@tagfinancial.com.au and then Emma or I will get back to you as well with your questions there today. Obviously, the advice and everything that we're going through here today is general in nature only. So really what we encourage you to do first, before you act, is reach out to whether it's Emma, myself, any of the guys in the Investment Advisory and Wealth Division, just around how these things apply to you before you actually jump in. So make sure you get that professional advice before you make any moves. As I said, so the end of financial year fast approaching. So what are we going to go through today? We've got some changes that are coming up. We've got some end of financial year actions, some strategies and opportunities, and then probably the thing that's most on people's minds and people's lips is the proposed $3 million cap and the extra tax that applies there. So we'll go through how that is proposed to work later on in the session as well. So looking at the planning checklist, so really, what are the key things when we look at superannuation? So, we're really looking at, very simply the ins and outs. So, we've got your contribution caps, what you can get in, your pension minimums, considering pensions versus lump sums, and Emma will touch on that as well. Asset revaluations. So I guess an obligation of the superannuation fund is to make sure its assets are valued at market value. That's really important as it relates to your capacity to contribute. And obviously, a higher value means a higher pension that you're obliged to pay. So valuations are really quite important. Equally as well, conditions of release. So that's really quite an important thing to think about because, your ability to satisfy a condition of release has an impact on how you can withdraw money, also has an impact on how the super fund could get taxed. So, some really important things to consider there. Okay, so on a contribution level, so, we've got a work test that applies still for those over age 67. That work test, again, it's the same work test. So 40 hours in a 30-day consecutive period needs to be satisfied before a member over 67 is able to make a concessional contribution. Okay, so what we're talking about there is a contribution that the member is going to claim a personal tax deduction for. That work test is in place. For those, what got repealed previously was the work test around non-concessional contributions. They're the contributions that nobody is claiming a tax deduction for. Okay, for those of you that are over that age threshold, but still being gainfully employed, you're getting your salary on a weekly or monthly basis. Well, obviously, you're getting super guarantee on top of that as well. So that's something that just will happen. Where it's an employer making the contribution, we don't need to worry about that work test. So the work test really applies to those contributions only you're claiming that personal deduction for. Okay, that cap, 27,500. So that's been the cap now, I think, for 2 financial years. It was $25,000. That 27.5 adds all your employer contributions and what you're going to claim personally together. So that cap there is an annual limit per person. There are some other things I'll get onto on the next slide that may alter that threshold, but just really important to consider how that applies before you put the money in because of how that gets taxed if you breach those caps. Looking at the non-concessional cap, that's $110,000. Really, that's 4 times the concessional cap. So as that concessional cap increases, so too does the non-concessional threshold. Again, with non-concessional contributions, we have that bring forward, so that up to 330,000 in a 3-year period. As I said, there's no work test that applies there anymore. The non-concessional cap, though, once you've turned 75, you have no ability to make a non-concessional contribution again, other than if you're selling your house and you meet the downsizer conditions. Okay, so there are some things that may need to be manoeuvred that aren't necessarily an end of financial year matter, but they are an age-based, I guess, restrictive matter. The other thing to think about with non-concessional contributions is your total superannuation balance will have an impact on whether you can make a non-concessional contribution, and if you can, how much that can be. So, very broadly, if your total superannuation balance is above, I think it's 1.47 million, if it's above that threshold, then you do have some restrictions and some caps on that 3-year bring forward. So, I do encourage you, again, as I said, before you jump in and make that contribution, seek that advice as well, because it's obviously, if you put in more than the threshold, then you'll be automatically above the cap. You'll be subject to excess non-concessional contributions tax, and then the associated earnings on that as well. So really important to get that advice before you jump in. As I said, there's some variety of contributions. So probably, when we look at some real, I guess, strategic tax advantage style around contributions, the idea of the catch-up contribution, that's now been in place now. We're almost through a full cycle, I guess, of having that 5-year eligibility. The idea of the catch-up contribution, any unused concessional contributions from the previous 4 years can be caught up in one big lump. On the proviso as well that you've got a total superannuation balance that's less than $500,000. So there are some advantages there. We do see a number of clients that look to take advantage of that catch-up contribution. Again, reach out and make sure you get that appropriate advice before you put the money in, because if you don't qualify, then you're not going to be able to take full advantage of the contribution. You'll also have excess taxes, and then you might also be unable to claim the deduction itself. So that obviously has a negative tax impact. So just really be conscious of those. Get the advice beforehand. It's the end of May now. We've got a good month to make sure that you get the right advice around the thresholds before you make any moves. One thing when we're looking at contributions, typically people talk about contributions as in putting money in. A self-managed fund, at least, is able to also accept other items other than cash, but there is quite a restriction around the type of item. So the most common item that we see there is the transfer in of listed shares or a business real property. So those things can also be contributed to a superannuation fund, covering either concessional or non-concessional contributions. Just be mindful, though, that there would be a tax impact of the sale of that asset to the superannuation fund. So you might have a capital gain bill that you're generating outside of super as a result. We've got their reserving strategy. So the idea of the reserving strategy is somewhat similar to the catch-up, which grabs prior contributions. The idea of the reserving is it's this year's plus next year's contribution as well. Okay, so you're able to double up. That idea of the reserving doesn't come, I guess, handcuffed with that total superannuation balance limit. But one thing to really be mindful there is if you're reserving next year's contributions already, that means next year you can't make any more contributions as well. Okay, so again, get that advice before you jump in, because the paperwork and the nuisance with the ATO often is something that maybe catches people by surprise. Downsizer contributions. So we've had the age eligibility now reduced to age 55. All the other requirements, owning the asset for more than 10 years, it having been the main residence of you and your spouse, payment within, I think, 90 days of settlement. those conditions are all still the same. So it's just the age eligibility that's now being reduced. So that eligibility just needs to be 55 for you or your spouse at the time. One other thing, which isn't necessarily an end of this financial year planning strategy, but we've got the super guarantee that is going up from the 1st of July, going up to 11%. So that's part of, I guess, the overall government's plan and charge to get it, I think, to 12%. So we're we're at 10.5. It's going to go up another 0.5% to 11. So that will kick in. So for those of you that run your own business, expect that to change and make sure your payroll systems are ready to cater for that in a month's time. Okay, so I'll hand over to Emma now, who's going to take us through the next phase here of the planning for the end of financial year.
Yeah, thank you, Jason. So we're going to look at pension minimums. We have now had for about 3 years since the start of COVID in March 2020, government allowed retirees to reduce what they need to take out of super to satisfy pension requirements, reduce that by 50%. That is in play till 30th of June. So all your pensions for this current financial year uh, are able to be reduced if you wish to take less by 50%. Obviously need to ensure that you are paying members' pensions well in advance of 30th of June. You don't want money moving on 30th of June and it not coming out and, bank putting it on 1st of July, that sort of thing. So give yourselves a lot of time. Make sure that everything's paid for this financial year, because if we don't comply, so obviously it's a contract between the trustees and the members, the fund does get exempt earnings. So as long as it pays and satisfies the pension terms, which is paying obviously at least an annual pension. So don't want the fund to be taxed. So just make sure that those pensions are paid. Now, from 1 July has been confirmed that minimum pensions are reverting back to the standard drawdown rate. So depending on your age at each 1 July. So there is no further 50% reduction. So we are potentially going to see, some funds may have some liquidity considerations that they now, having paid 50% less pensions to members over the last 3 years, potentially that may cause, or even if members jump up, age brackets and now they're at, 6% rather than 5%, and various things can add to the liquidity to ensure pensions are paid to members. So if you have any concerns with the liquidity of your fund to be able to pay pensions to members, please come and see us. We obviously need to look at things like, the assets generating sufficient income to support pension payments and obviously other expenses of the fund. Do we just need to crunch and liquidate some assets to free up some cash? And maybe look, maybe you're not, you don't want to be forced to take any more pension. So there are some considerations that we can take in that sort of situation too. But please, if you're in that sort of you have those concerns, please come and see Jason and myself, and we can step through what's right for your fund and the members. Just quickly on that, we, for all our clients in pension phase, there is an email communication coming out from us next week, just to basically remind everybody what the fund's minimum pension is that must be paid. So obviously look out for that. And if you don't get the email, please contact me and just make sure that that the pension's paid. And that's going to go out regardless of whether you have fully paid the pension for the year. If that is the case, that's great. So it's merely just a reminder. So yeah, watch out for that one. If we move on, we're going to look at investment valuations. So again, big topic that we discuss every year. Obviously, investments of the self-managed superannuation fund are required to be valued at market value each financial year. For properties, it's more so a 3-year requirement, unless you've done some significant changes or something's going to fairly impact the value of that property in the meantime, if we're between the 3-year period. We will obviously normally say, it's been 3 years, this year we need a valuation, but probably just keep that on your radar that, if it's been a while, start approaching real estate agents and getting those valuations done so they can get through to us for your 2023 accounts. With the rental appraisals, I would suggest that you time them, again, they're 3 years, probably time them up with the property valuation itself. And this is more for required where the actual property is leased to a related party, your business or something like that. Obviously, the auditor is wanting to see that rent is being paid on a commercial arm's length basis. So just some documents that we need every 3 years. Just get that into your to-do lists so we can have that for audit purposes. In terms of collectibles, again, there's no investment that doesn't need to be valued at market value. This one's more each year. There is a few added complexities with collectibles. It's got insurance requirements, storage requirements. So I probably won't dwell too much here. Again, if we need an appraisal, put that on your to-do list. And if you need guidance or assistance, probably best to contact us because it is a bit of a specialty area, having collectibles in a self-managed fund. Okay, crypto. I think crypto has, people have dabbled in it and we've seen, funds do that and they sort of, have their fun and it's not so much of a, they're petering out a little bit, but nevertheless, crypto does also need to be valued at market value. Now, there are good platforms out there that produce useful tax reports, buy, sell, transaction reports of all the happenings during the year. They can also link to, and really good to look at page subscription services because they condense down, significantly the transactions that the crypto provider reports provide, if that makes sense. So it's really condensing down. So you might buy one Bitcoin, but you're buying it from 40 different people. So in without this paid subscription service, you've got all of those transactions in the one purchase of one Bitcoin. So it could potentially be quite beneficial and obviously a lot easier for us. So there are those types of services out there that make, holding crypto, reporting it for tax purposes a lot easier. Now, for your investment strategy, again, as trustees, your investments may change during the year. Maybe the dynamics of the types of investments have changed. Obviously, year end is a good time to review that, the suitability of the strategy, update it if required. And we will always send out an investment strategy for the trustees to consider and obviously update on a yearly basis. And look, the real auditor really just wants to know that you have a strategy and that you've invested in line with that strategy. That's all they want to see. And obviously it needs to consider insurance and that sort of thing. So if you've had significant change, then it's time to update your investment strategy for the fund as well. Estate planning. Okay, so wills and binding death benefit nominations. So it's just good time of year to reflect on everything, make sure everything's still current. So, okay, do you have wills in place? Are they current? Do they reflect my wishes? Have there been, any changes that I really should, update my will soon? Those types of things. Your binding death benefit nomination, super doesn't actually automatically form part of your will. So a binding death benefit nomination really links and cements your superannuation benefit to be paid through to your estate. If you don't have that document, your super won't form part of your will. And even if you've got it listed in there, you need the two to link together and, pay through to your beneficiaries per your will. That also just allows, it cements your wishes of how you want your superannuation death benefit to be paid in the event that that you pass away, and it doesn't leave sort of anything open to trustees using discretion or deciding how to pay that, and that may not go in accordance with your wishes and that sort of thing. So, critical documents to have on file each year. And again, if something was to change and you need to update the binding death benefit nomination, typically they don't expire these days under newer trust deeds. Um, but again, it's good to review that always with your will and just make sure it still satisfies your wishes.
Probably just before we move on to the next
Hmm.
slide, I'm just going to add a little comment there into the chat. But yeah, just remember with regard to death benefit nominations that so the death benefit nomination will, if you have one, will apply to your accumulation balances. If you have pensions, then if those pensions have been established as a reversionary pension, then that reversion will take precedence. For some clients, they have multiple pensions in the one fund. So each of those pensions will need to have their own, I guess, decision around a reversionary beneficiary or not. So obviously, if it's reverting, it's going to revert to your spouse. In the absence of any reversion, though, then it, I guess, more or less forms the pool that gets decided or divvied as per the death benefit nomination form. So again, a lot of the newer deeds have a lot of flexibility around the nomination of a reversionary beneficiary. So that should be considered. But as Emma said, obviously considering while super is not part of your estate by default, considering what happens with your super in line with what you want to happen with your estate is obviously the most prudent time to do it. And so, yeah, often it's looked at together.
Yeah, thank you. So our trust deed, yeah, we generally suggest that a deed is no older than say 5 to 7 years before it really needs to have an update. Look, there is things in there that refer to the SIS Act, and then there's things in there that expressly allow members to do certain things, and that's more around estate planning. So if your deed allows and it has more flexibility, obviously, things are changing all the time, so you don't want something that doesn't have, provision for an enduring power of attorney not to stand in your shoes in case of incapacity or something like that. That's really governed by the trust deed, and you really need the deed to allow for these types of things to have, greater benefit in the fund and greater flexibility around these types of matters. Generally, when we meet with you each year, we will look at the trust deed age as well and obviously suggest an update. So it's just something to keep in mind. Okay, if you're in a transition to retirement income stream, now these are, you're still working. These are not full account-based pensions where you get, tax exemptions and you're subject to the transfer balance cap and all those types of things. This is where you are restricted to have only taking 10% out. It's still like an accumulation account, but you've got access upon preservation age to your benefit in the fund. Now, if you satisfy a condition of release, so maybe you've turned 65 or you've retired during the year, on satisfying a condition of release that doesn't have a restriction, your TRIS actually moves to the retirement phase, which is essentially an account-based pension. And that happens at the time of the event that happens. So, for example, you're in a TRIS for the full financial year, yesterday you turned 65. Well, technically, yesterday, your pension goes into the retirement phase. So then it's subject to the transfer balance cap of currently 1.7. You get tax exempt earnings on the portion of that benefit in the fund. You lose the 10% restriction, all that type of thing. So we are doing a mail out. We're identifying those clients that might be affected. Obviously, we're looking at age 65, but if you have retired during the year, or even if you're older than 60 and you've left a job and gone to a new job, that's a condition of release as well. So please let us know if you're in those categories, because there is things to your transition to retirement pension that we should be putting in place to make that more tax effective and various things. So yeah, that's all I wanted to cover there. Next slide is our transfer balance cap. So we've had this in place now since 1 July 2017, started at 1.6. It was indexed a year ago, I think, 2 years, to 1.7, and now, because of the events of the last year and inflation, etc., it's actually jumping by 200. So it's going to be from 1 July 23, $1.9 million. Now, before everyone gets too excited, if you're already in receipt of a retirement phase, so whether it's TRIS in retirement or an account-based pension, before 1 July 23, then you're not going to get the whole 200,000 added to your transfer balance cap. So you can't automatically get another 200 from your accumulation into pension phase. You're going to get a proportionate increase. You're only entitled to the full 1.9 if you're currently, before 30th of June, not in a retirement phase income stream. Then you get the full cap. So for those in pension phase, the ATO is going to update by 11th of July. Your new transfer balance cap will be available, and that will obviously flow through to our systems. We obviously need to lodge TBAR reports, which is any events affecting pensions during the financial year, and we obviously do that on your behalf. There is some considerations that we might be able to maximise, the increases in the transfer balance cap. And obviously, before I go through these, it's critical to ensure that you get the proper financial advice, because we are talking about pensions. It's a financial product, and you really need to get advice around this before implementation. So if you're not currently in a transfer balance cap or any sort of retirement pension, maybe you've retired or you've turned 65, and maybe we consider delaying pensions to the next financial year. Even if you are, and you might be able to, the increase, maybe you've, made a non-concessional contributions, maybe you defer that so you can get more of an uplift in your transfer balance cap to the next financial year. But we have to weigh this up in terms of, you're not going to get an ECPI, which is your tax exempt earnings for the financial year. So it's a bit of a weigh up, what's better, an increase or actually getting the tax exempt amount now. So all things to consider, and just wanted to put that out there that, the cap is increasing to 1.9.
Yep. Probably just before we move on to the next one, Emma, I was just going to add with that. So I know one of the common questions that that we see then, or the first question we tend to get is, okay, well, let's stop some pensions. So with that in mind, clients might want to stop a pension and then go, okay, well, let's stop everything before 30 June. It doesn't count that way. The ATO will look at the highest ever, I guess, use that you've had. So if you've maxed your transfer balance cap at any point since it started, you won't get anything. So stopping a pension isn't going to help you get access to that extra indexation.
Yeah, no.
Yep.
Very correct. And we're going to have, instead of having everyone at 1.6, we've got all types of transfer balance caps amounts between 1.6 and 1.9. So
yeah, that's correct. I know that's sort of something that I guess the industry has sort of requested a little bit of simplification on, but I guess I'm doubtful that that's ever going to come into existence. Before we jump on to the next slide, so just Helen, with your question there, just about putting a downsizer contribution, and does your deed need to allow for it? It doesn't need to allow for the fund's ability to make a downsizing contribution. You just need to make sure that you satisfy the conditions that I went through before. There's a few other little conditions, but those ones I touched on before are the main ones. There is an ATO form that needs to be completed, but that form doesn't need, at the time you make the contribution, it needs to be completed, but it doesn't need to be submitted to the ATO or anything like that. So the one thing I will add with the downsizer, while it allows you to get more money into super, and it's not hamstrung by the size of your superannuation balance, it's not something that can then get added to a pension and sit over and above this transfer balance cap. It's just more money that you have in accumulation phase. So if it's adding to the accumulation pie, then obviously it means that its earnings are taxed at 15%, as opposed to taxed at a personal marginal tax rate if you're investing it outside of super. The other side is that it's implying that you've sold the house that you're probably currently living in, so you're going to need to live somewhere. So just think about that. Often we have people that might downsize, and it's downsizing in name only, not in reality.
Yeah,
The property they move into tends to maybe be smaller but more expensive. So the spirit's there. It can be done. Nothing that you need to, I guess, update your deed to fit in.
to expressly have, yeah.
Yep. Cool.
Okay, limited recourse borrowing arrangements. So for super fund can borrow, and it can borrow from a bank or a related party. So I'm just going to focus on the related party aspect of these loans. Now we've got a practical compliance guideline that sets out what a related party loan looks like if it's on arm's length and commercial terms. And this, if you're in line with these guidelines, then the ATO say we don't fall foul of NALI, which is, taxing all the income at penalty rates because you're not on a commercial loan. So the interest rate itself is the Reserve Bank of Australia indicating leading rates for banks, et cetera, you point to there. Now, that has been 5.35% for property and 7.35 for shares if the super fund borrowed to purchase shares. Now, with the events of the last financial year, now that rate is going to be locked in next week, but is currently sitting at 8.6%. So that is quite a jump from what we have over the last couple of financial years. And potentially that's going to really impact the liquidity and being able to repay these loans back to the related parties. And it must obviously make monthly repayments based on the interest rate, that sort of thing, under the PCG to obviously remain compliant and not in breach of not being commercial. I will look at the liquidity impacts. I just firstly want to go through an example. So at the start of this financial year, there was a limited recourse loan to a related party. It was valued at 415,000. Now, based on all the criteria and the interest rate of 5.35% that was in place for this financial year, monthly repayments come to 3,510. So each month the fund was paying back $3,500 to the related party to satisfy the terms and conditions of the loan. At the end of this financial year, we've got a balance of just under $395,000. Now, if we take a year off, increase the interest rate, now what we've got from 1 July is a monthly repayment each month of $4,210. So an extra $700 a month and, $8,500 for the fund to generate an income to afford to be able to pay back to the related party member to keep these loans compliant. So quite a bit of extra liquidity required. If we go to the next screen, now how to manage this increase. A few suggestions, a few things to look at, okay, maybe they're in a position to make non-concessional contributions into the fund. If we go back to what Jason was talking about at the start of the year, there's TSBs and eligibility requirements and things, so it may or may not be an option for the fund. Now, where the loan on the property or the shares was taken out or refinanced after 1 July 2018, then there is an impact on the outstanding loan balance on your total super balance that you need to sort of add back, which may potentially preclude non-concessional contributions from being made. So just to a reminder for that one. Okay, do we potentially roll over? Do we add new members? Do you have external super? Things like this. We probably, potentially need to look at all opportunities to see how the fund is able to best manage this. So I've talked about sort of two kind of increases from 1 July, being your pension going back to normal, and obviously the increase in related party loans. So potentially we've got double the liquidity matter to really address sort of come the new financial year, how we're going to especially if the fund is few members are in pension phase and the fund has a limited recourse loan as well. So, potentially there's a few funds may have a double whammy here. So we, get the best advice, plan, plan, plan.
Before we jump on to the next slide as well, one other way, I guess, to try and boost, I guess, the cash that comes into the fund. Spoke about non-concessional contributions, rollovers, depending on who the tenant is on the property. So if it's a commercial property, then it could be a business that you run. Look at the suitability of the rent. Obviously, it needs to be in line with a lease, and it needs to be commercial, as Emma spoke about before around valuations. But maybe getting at the higher end of the valuation range as far as what is a commercial rental yield might be something that could, I guess, help assist against the liquidity strain in the fund. Obviously, the higher the rent, then the larger the tax deduction that your business gets. So there could be, I guess, a bit of a double positive there in dealing with this situation.
Yep. Okay, market-linked income streams. Now, these types of pensions, or previously lifetime complying pensions, now these were only set up between 2004 2007, and the members had to be retired. So um, people that are in receipt of these pensions are now sort of, late 70s, mid 80s. Maybe they're wishing to simplify their affairs because it's really not a flexible type of income stream. It was good back in the day for various matters which are no longer, really applicable under the superannuation legislation. The government, well, the previous government did a few years back moot a potential to like an amnesty to get out of these things. There has been no update, so we still can't get out of them. And I don't know. Who knows? Is it doubtful? I don't know if it'll ever come through. Um, Now they are restrictive. You can't commute them and those types of things. So if you're wishing to simplify your affairs, look, there is a few things that we could consider. Obviously, if you have these types of pensions are concerned, is very situational dependent. So please come and speak to us. But there's things like, should we change the terms and conditions of the pensions? Do we increase pension payments so you're taking a lot more from the fund and really draining it a lot quicker? Or maybe it's even as simple as if it's reversionary, maybe we cease that so it doesn't revert to a spouse. At that point in time, it sort of ceases, and that, yes, you've got it until death, but your spouse doesn't then inherit this inflexible type of pension. So and it doesn't go into reserves and those types of things. So there's a few little things. I'm not going to go into transfer balance caps and the like, but a few little things that may sort of help expedite, getting these pensions through their expiry and off the SMSF radar. Okay. Last matter that I wanted to talk about before Jason gets onto the juicy stuff with the $3 million cap is electronic service address. Now, this really is a BGL. We use BGL as a software provider, and this is only going to affect people that are receiving employer contributions and the fact that we use BGL. So from next financial year, they're no longer going to support the electronic service address. So essentially, that is an address. Your employer pays you your SGC, gets reported to the ATO, a notification comes through, then we know that you were paid, X dollars of SGC on this date from this employer. So it's only going to affect employer contributions because if you were to roll over from into or from a self-managed fund, yes, we need to do that via SuperStream, but we've already had to update your ESA, your electronic service address, to something that's not AusPost SMSF. So now we will no longer support AusPost SMSF, and really we'll be updating you. If this affects you, on 1st of July, we'll do a bulk update to change the ESA. And then you'll know you need to, if it affects you, you need to notify your employer. So SGC payments can still continue to be reported for you through the SuperStream system. So it's not it's really a software provider issue. I just wanted to sort of alert that it's not an interest, AusPost SMSF is still out there, but yeah, no longer supported through the software.
Yeah, and just following up on that as well. So yeah, we're going to press go on all those changes on the 1st of July 2023 because that's the cutoff date that we've been told by the provider. The reason we could cut it off earlier, but we don't want to jeopardise any contributions that your employer tries to make this side of 30 June, just being mindful of caps and those sorts of things. So it'll all happen on the 1st of July. We'll get communications out, but then, yeah, the obligation will then need to be for those affected and still getting the employer contributions to update your employer, the payroll team for your employer, so that they make the appropriate change. So, yeah, that will all take effect in a month's time.
Yep.
Okay, so moving on to the $3 million cap. So we're still sitting in a bit of limbo because while a lot of governments like making huge announcements, we don't end up seeing a lot of actual detail. So nothing's hit Parliament's floor. Consultations have been open to, I guess, the public. And I'll touch on a few of the issues here today, but just wanted to get through a bit of what it means, or what it looks like it's going to mean, a bit of an example of how it gets calculated, and then as well touch on some things that maybe can be done. But I guess keep in mind what can be done. We should first wait to see what is tabled and what the future actually might hold before we, I guess, jump at too many shadows here with this proposal. So obviously the 3 million cap is proposing to tax earnings that are attributed to your balance over $3 million. Okay, it's going to add an extra 15% tax to those earnings. So effectively, for those earnings, there is a 30% tax rate that will apply. We have seen, sort of a lot of the media talks about it's a 30% tax rate. Well, it's not exactly a 30% tax rate on the whole thing. That's oversimplifying the calculation. Effective date or application date is going to be from the 1st of July 2025. So we've got a few years still up our sleeve, but obviously we need to see legislation so that affected people can make some plans. The most contentious aspect that we've got with the 3 million cap, I think, is the lack of indexation. So the proposed threshold is 3 million. The proposal is that it never gets indexed. I think if you reflect back, $3 million in 2003 is a lot different than what $3 million means in 2023. So while the proposal and while the I guess the promotion around this is that it's only going to affect somewhere between 50 to 80,000 people in the country, without indexation, that number is going to get quite dramatically higher very quickly. Okay. The additional tax is going to be issued again by the ATO, obviously, but it'll be assessed to you as an individual. You then can elect to have your fund pay it, or you pay it personally. So, just be aware that there is that added complexity because all governments like creating complexity. I'm going to go through a bit of an example here, though, about how they're going to go about the calculations. So, we've got an individual here, Warren. He's 52. I guess the age is sort of somewhat irrelevant, but he's 52. He has $4 million in super. Okay, he makes no contributions or he makes no withdrawals to his fund. So a year later, his balance has grown to $4.5 million. So his earnings, according to the ATO, are $500,000. All right. Now, these earnings, I spoke about indexation being a contentious aspect. These earnings include unrealized gains. Okay, so just think around, things like properties or shares, or, from a volatility standpoint, things like cryptocurrencies. A huge unrealized gain will create huge earnings. So if we look at this, we've got $500,000 worth of earnings for Warren. A third of his total balance, so you can see 4.5 million to 3 million. So 1.5 million is above the threshold. 1.5 million represents a third of his total balance at the end of the year. So what the government proposes is 1/3 of those earnings of that $500,000 will get taxed at 15%. So you can see here the additional tax liability that would be assessed to Warren would be $24,750 that would go to him personally. So, that creates quite, I guess, a significant liability in Warren's hands. He can choose to pass the buck to his superannuation fund, but again, if these earnings are all unrealized gains, where is that liquidity coming from? Either for Warren or his fund to pay this tax. So again, that's where, from a contentious aspect, having unrealized gains, this will be the only true taxing point of unrealized gains in the tax system. So it is quite contentious in that aspect. So, we really need to be mindful or consider the flow-on effects here. So particularly, as you can see, sort of down in the potential flow-on effects, here is the cash flow issues. So while it's not a pure 30% tax, depending on the size of the earnings and depending on what's realised and unrealised, there may be a significant cash flow issue that gets presented, firstly to the individual, and then they can choose to pass that on to their super fund, but ultimately it's getting taxed. It is creating some inflexibility for the individual. So, I think most of the industry doesn't see an issue where this tax gets applied to realised gains, because you've gone and sold something, you've actually created that wealth. One thing people ask, and one of the points we've got here, is what happens if all those earnings get reversed next year. So let's say you've got an asset that's performed awesome in one financial year, the next financial year you lose all of that wealth. Well, I mean, what the government's proposing at this point in time is that decrease will form a credit that you can use for future financial year increases. And so basically they say, well, it's not, in their eyes, that decrease will get used in a future financial year. So that works all well and good if your assets then rebound in future years, or we've got there at the second point, just don't die, because once you die, like a capital loss in your personal name, it'll disappear with you. So they talk about the extra that credit sitting there, but again, like any credit, you've got to have income in the future to be able to offset that credit and use it. So one of the calculations there, the calculations of earnings, are significantly different to taxable income. Well, really, that is that you're going to they're proposing to add your unrealized gains. At this stage, while they say they would like to find a way to work out how this applies to people who are receiving, who have defined benefit superannuation balances, at this stage, the government doesn't have a method to work out how they can factor that into the $3 million cap, which is nice, because I think a lot of parliamentarian pensions are defined benefit pensions. So at this stage, most of their pensions don't count. We spoke about the cash flow issues, the balance decreases as well. One thing we've got to look at there, revaluation of assets. So, particularly as we, dwell back property assets, we tend to revalue less infrequently. It might be more prudent to revalue these things every year so that you're never hit with this large, significant bill. That's one way we can look at sort of addressing it. People have talked about, well, what if I take money out of super so I get below the $3 million threshold? Well, that's another way to look at it. But, you then need to invest that wealth somewhere else. And that then gets taxed, at your marginal tax rates. So, we're talking about an additional 15% tax here. You got to make sure that that's your marginal tax rates are significantly less than that 15% tax before, it starts creating a better tax circumstance. Allocations from reserves. Look, a lot of self-managed funds don't have reserves. Emma spoke about the complying pensions and those sorts of things. I think typically that's where we see the reserves coming through, which is perfectly fine. But just got to watch out for that as well. Yeah, Emma, did you have something you wanted to go through? Or?
No. Peter Haynes got a question
yep.
there. Pay the normal 15% on his 500,000. Well, it depends on what. It goes back to that point that calculation of earnings for this cap is significantly different to taxable income. So it wouldn't be a straight 15% on the 500, because that might have unrealized, gains in there and that sort of thing. So, yeah.
Yeah, the other thing with that, Peter, as well, is that, you know, you might have a pension that runs in the fund that gets taxed at nil within the super fund. So, you know, in the example of Warren, all right, he's too young, but let's assume he's 72 instead, and that the 4.5 million that he's got by some, you know, good grace of good investments is fully in pension mode. Well, then his income tax in the fund is nil as it currently is, and then he's just got this extra 15, he's got this extra liability outside of super. So you know, while we're talking about the 15% and the 30%, that's quite a simple way to look at it. It's not going to be that high, but I think the most contentious things that we see are around the lack of indexation and the fact that they're including unrealised gains or unrealised movements in this calculation. And there's quite simple ways to sort of cater for particularly the unrealised gains through tax returns and member statements and those sorts of things. So it is easily it is easy to administer if they chose to remove the unrealised element of it. And yeah, fingers crossed we see some changes around at least those two aspects before it sort of starts trying to make its way through Parliament. But the proof really will be in the pudding once we see legislation. And fingers crossed that we actually receive legislation well in advance of the 1st of July 2025. So, you know, we've got 25 months and that will disappear. So the reason for the effective date there is that will be after the next election, and Labor statements around this were that in the election that has just passed, that they weren't going to make changes to superannuation. So this is their way of saying that this change won't take effect until after the next election. So they haven't broken the current investment promise. So what's next in regards to that? We do need to wait and see. Yeah, Michelle, as you mentioned there have been a lot of submissions around that. So yeah, we do hope that a lot of those considerations get taken into account before things get tabled for consideration. But till we see it actually tabled, until we see it progressing through Parliament, this is the current state of play. There's a couple of things we've just got to watch out for. And as we get a bit more certainty around how this is going to be taxed, etc., then we can start putting proactive plans in place as best we can. So that's more an information that this is the current state of play, and we've just got to watch out and stay alert.
Yeah, and I think just to add the third, potential, issue or cause for contention is the death benefits as well. What if your spouse passes away? You both now got less than 3 million each, but that's going to have, potentially significant impact on the surviving spouse. We're keeping, if they're able, subject to caps and things, keeping amounts in super. So, that's another big one too.
Yeah, that's right. So a lot of complexity, a lot of uncertainty still, but still a lot of talk about it too. And it's a lot of interest from everybody affected, because we do think that it's obviously a significant change. And like we always try to do, we try and be proactive and try and make positive, strategic manoeuvring that gets dictated from there. So as far as everything goes, thanks very much for your time today. Much appreciated. For those of you that that want to stay on and ask some questions through the chat, you're more than welcome to. Appreciate the questions that have come through, and we'll see you again soon.